Well, hello, ARQ clients, friends, colleagues. This is Rich Siegel with ARQ Wealth. It is Thursday evening, 6:15, March 26th, and just wanted to give you a quick market update. As you can see here, this is a chart I wanted to show from peak to trough of the market decline. This looks like February 19th was the top, and the bottom so far was March 23rd. And you can see from peak to trough, I have 5 indices here, the worst of it being small cap stocks. That's the Russell 2000. The Dow Jones was the second worst at 37%, about 34% for the S&P, 33% for the MSCI EFA, Europe, Asia, Far East. And the best of it is emerging markets. That's from peak to trough. Since the 23rd, we had a really strong rally. And one of the characteristics of a huge waterfall market decline like we've had is gigantic up days as well. So over the last 3 days, the markets are up double digits, which is really nice. It's a nice break. And a chart of that comeback would be right here. So you can see those same indices have this huge rally up, about 13 to 17% off the bottom. So it's kind of nice to see that through all this turmoil and volatility and uncertainty, the market does not just go straight down. So that can give you some comfort that there are some big up days as well. Over the last few weeks, bonds have also had a rough time. So this is about the same day here, the 19th, that stocks peaked, all-time highs. Bonds held up till about here, and they fell down as well. High-yield bonds or junk bonds took it on the chin. They have a pretty high correlation to equities. Investment-grade corporate debt is this orange, and then here you have municipal bonds and, of course, the highest quality treasuries, mortgage-backed securities, and the highest quality corporates here. From peak to trough, some of these asset classes have dropped 20%, 10%, 8%. They've been coming back with stocks. So the nice thing is that although they have been correlated on the downside, they're also correlated on the upside. And one of the things that we've noticed here is that since the Federal Reserve and the government, the Fed, has done everything to support the credit system in this country, bond prices have come back pretty quickly and have stabilized. And we would expect that higher quality bonds will be more tame going forward. I wanted to show you something else here. This is the VIX that we've spoken about before. The VIX is the implied volatility indicator, the fear index. It hit 85, which is almost at an all-time high, if not an all-time high. It hit 80 also in the credit crisis. Normally, it kind of stays in these valleys here. And it's currently at 61. So what that means to you is that volatility up and down of 3 to 5% on a daily basis is going to be around for a while until this gets down below the 30, 40 range. These moves will continue. And what we think will cause that to go down to the lower ranges will be more certainty that the virus has peaked in the US and is leveling out. Additionally, the market already has priced in kind of this worst case scenario, which is horrible economic output. We saw it today with initial jobless claims of over 3 million. So I think the key here is to get some more data around the virus. I think knowing that things are improving will really help the market. But just keep in mind that although we had this 37% low on the Dow and we've bounced back dramatically, I wouldn't be surprised to see the market retest that low. And hopefully when it does this, you'll be mentally prepared this time. What happens is you have this panic sell-off, this panic low, okay? And we had that for sure. Then we start getting more data. We start getting some stimulus and some assistance from the government. That's already in the cake, baked in the cake as well. We had this great rally off the bottom, this reflex rally. Now the data will start coming out about GDP, and the virus will get a little worse, and the market may go back down another 10 or 15% again and retest that low. So just know this, that the portfolios have been slightly de-risked. The portfolios we've had more quality equities and bonds added into the allocations, and that hopefully now that the credit system is being backed by the government, we won't see the type of drawdown on bonds that we saw a few weeks ago, and bonds will decouple from stock price movement, which will help support the value of the portfolios. Anyway, hang in there. We expect some more volatility to come, and we expect a lot of news, and we'll keep you posted with more of these videos. Thanks for listening, and have a great evening.